Namaste and good evening to all students who are present, and welcome to the second session of Economics for Finance class. I hope you have gone through the lessons yesterday. I hope you have gone through the lessons which we have learned yesterday and you understood, and also through the questions. That is the question bank I have prepared. I hope after reading it, you are able to answer all the questions. If you can answer all the questions, there is no doubt you can answer all the questions in the examination also. So today's class is a little adventure. Why I say is we need to finish 2 units, and that too a little complex units. You know, it's government intervention in the market and fiscal policy. So we will be trying to finish the entire two units. I need your cooperation. I need your attention. That's all what I want, right? So let us start now. Usually we start by revising yesterday's portion, but we don't have much time for that. But just for information, we have learned market failure yesterday and fiscal functions. And we know market failure, what it is. It is, do not misunderstand. That is, when markets fail, it doesn't mean absence of market. Markets are there. They don't totally collapse. They simply fail to create a socially optimal outcome. That is the problem. So government can always, some mechanism can always be there by which, you know, the market can be corrected. And that is government. That is the role of government. Let's repeat what we spoke yesterday about market failure. We know the reasons for market failure is market power, externalities, public good, and asymmetric inflation. So this topic of market intervention also will go in that sequence. As I said yesterday, I'll be teaching totally from the examination point of view. In-depth, deep knowledge is not possible within this time period, but for the time being, I think passing of exam is most important. So let's start the class. And what is the reason for government intervention? You know what Adam Smith used to say? Okay, government is minimal. Government should be minimum or minimal. But later we understood, yesterday we started with the example of COVID, we understood that markets may sometimes be faulty. And so the reason for possible government intervention is nothing but market failure. So to repeat, market failure is the reason for government intervention. Of course, the market alone cannot function. There should be some basic framework. That is the next paragraph of your study material. That is a basic framework under which, you know, the market functions. As we said yesterday, you know, there are physical infrastructure, like, you know, roads and so on. Then financial infrastructure, legal infrastructure, and all types of infrastructure provided by the government in which the market can function. So we know that there is a rule of law that is there. Like you do your contract act, you know how contracts can be enforced, isn't it? And let's go to the lessons. That is the first one, the market power. How does government solve the problem of market power? As we said yesterday, market power is monopoly power of some degree. It need not be total monopoly power. It is monopoly power. Whenever there is monopoly power, consumers can be exploited. Prices will be higher. So monopoly means, you know, the size and structure of the business or the industry is such that they can make prices and charge higher prices. So what are the, and they can involve in restrictive trade practices. What is restrictive trade practice? A practice followed by a trader or a producer by which another person or another business is not able to perform efficiently. So the actions of one entrepreneur or one trader prohibits or prevents efficient action by another person. And so for controlling monopoly, there are a lot of anti-monopoly laws. Anti-monopoly, that is against monopoly. I think you learned quite a lot in other papers. That is how government can control restrictive trade practice. So in India, we have what is known as competition law is there. That is how competition, how the government is trying to bring in competition. What is the objective of Competition Act? Our Competition Act aims at bringing in, sufficient competition in the market. Because whenever there is lack of competition, there is exploitation. In different countries, this is known in different names. For example, antitrust law, it's given in your book. Antitrust. What is anti? Against. Trust. What is trust? Trust, cartels, etc. are in economics. A trust is a business combination. That is, businesses combine together, and once they combine, they become huge, they wield monopoly power. Right? And so, this is how they are able to explain. So, trust is not beneficial for the market. And so, any type of formation of, collusion, we call it. Collusion is joining together, tacitly, secretly joining together, entering into contracts, contracts to restrict output, contracts to fix prices. There can be business combinations. Actually, there are secret combinations that are taking place in almost all in almost all business, because the cement manufacturers will have an association, the cotton textile manufacturers will have an association. But these associations should not be for exploiting the consumers or like that. And so there can be collusion. Collusion is secret understanding, right? There can be cartel. You have heard about a pig, a cartel. There can be predatory pricing. What is predatory pricing? You cut the prices, slash the prices so that nobody is able to enter and sell. Only you are able to enter. Only you are able to. So you're trying to drive out people. So that's why lots of legislations are there which will prevent combinations, collusions, associations, organization of business for the purpose of exploiting with market power, for the purpose of restricting output. In your book, some examples, maybe 10 examples of only 10 examples. There are hundreds of examples. So when application question comes, you find out what is the objective of this intervention. Is it reduction in market power? As you read the question, you will understand. For example, I'll mention a few. Liberalization. Liberalization means, industries are free to enter any particular business, so that the number of businesses in a particular industry increases. Whenever the number of producers or suppliers increase, what happens is competition among them will reduce the price. So all types of encouragement for competition, controlling of mergers, price capping, setting the maximum prices, then tough investigations into cartelization. Cartelization is formation of cartels, unfair practices, restriction on monopsony. I am reading from the book, you can keep your book open. Restrictions on a monopsony power. What is monopsony? If monopoly is one person selling, monopsony is one person buying. Naturally, he'll be able to fix the price, isn't it? Then reduction in import control. When imported commodities enter our country, what happens is it will compete with the domestic producers. And so naturally, domestic producers have to, keep pace with, they have to keep the prices lower. They have to keep the cost low, and efficiency will naturally come. That we will learn in the 4th chapter. Ultimately, government may even go for nationalization if things are not okay. For example, in 1969, we know the banks were nationalized because they were not doing their duties properly. Right. But do you think monopoly is always bad? Not bad. We have heard about patents, copyrights, and legislations that give exclusive rights. What is the meaning of exclusive? You can exclude somebody else from producing this commodity or service. It is not only production of goods, processes. A particular process I have invented and nobody is supposed to copy that. I'll get a patent right. I think you know all that thing about it. Then this is a reason why patents are given, in order to encourage research, in order to encourage invention, in order to encourage innovation. Right. Then sometimes, natural monopolies are there. That's also given in the book. What is a natural monopoly? Certain activities can be very profitably at low cost provided by one huge producer. What happens is lots of economies of scale. What is economies of scale? As you increase the scale of production from zero, it goes like that. Your average cost keeps on coming down. The long run average cost keeps on coming down. So if you're producing lower levels of output, your cost will be very high. If you praise this, if that firm is able to produce huge output, then their cost will be lower. Naturally, lower the cost, lower will be the price also. And so sometimes government encourages, in the interest of the public, this type of natural monopolies like water supply. There's no point in having a parallel water supply. There's no point in having a parallel electric lines being drawn by different electricity suppliers. So that is natural. So all these are activities for reducing the market power. So as you read, you understand what is wrong with market power. What is this action of the government for reducing market power? When you read Business Daily, every day you will come across regulations, to reduce market power. The second reason that we studied in the previous class is externalities. So please be with me. This is very, very, very important. Externality, positive, negative. I hope you have read through yesterday. These externalities are important causes of market failure. And so whenever there are externalities, the government will enter and intervene in the market. Why do you call it an intervention? Usually, market decides the price by the forces of demand and supply. And government intervenes into the market so that, this process of price determination is influenced by government. Okay. The process of free operation of market is actually influenced by government. So for externalities, there are two types of intervention by the government. One is known as command solutions, that is regulation. Command solution. The government commands, do this, don't do that. It will try to, bypass markets. That is Okay, markets may be good, but see, markets have to function according to the rules and regulations. These rules and regulations are put forth in order to, in order to reduce or increase. If it is positive externalities, reduce the negative externalities or encourage the positive externalities. So the government will force you to act according to law. Government will pass laws that by which, firms have to change their behavior. Consumers have to change their behavior. For example, smoking in public places is banned. So consumers have to change their behavior. Firms have to change their behavior. Sometimes they will not be able to maximize their profits. You know the examples. For example, government may even ban. We know the example of, Sterling. That is Anil Agarwal's business, huge business. And they had their zinc smeltering units which were polluting Tamil Nadu. It was a big problem. And what happened finally? They have banned the sources of pollution altogether. So there are many industries, which are being banned because they have sources of pollution. And, cars, cars, when you're using, cars, you have to adhere to certain standards of pollution. Then, firms will be asked to supplement along with the production unit, this environmental hazards combating mechanisms. Technology provides a lot of provisions for internalizing the externality. That is, you need not throw away the emissions into the rivers. Rather, you can clean the emissions and then put it in. Okay. So emission limits, that is a number of examples are given there. And whenever application question come, what you can find is you have to think, what is it that the government is trying to solve? Okay. So prohibition, right? Prohibition of certain activities. When government prescribes very high standards of environmental quality, environmental standards, emission standards, what happens is, the cost will go up. When the cost goes up, existing firms will definitely survive somehow or the other. But new firms, they will find it very difficult to enter. Right. And the government will monitor. For example, in the case of cars, when you go for registration, what is the, you need a certificate pollution. That is the tailpipe emissions, whether it conforms to standards. There are many standards. European standards are there. VS standards are there. So pollution testing will have to be done. All these are some examples. I think this part is very easy. So the first approach is regulation, direct control of, people who create negative externalities. But that is simple, you can read. Now we go to the second and very slightly tough, but I will make it clear for you. Be with me. The second policy is market-based policy. Market-based policy. What is the meaning of market-based? Market-based means definitely this is an alternative to command and control or regulatory solutions. So when you go for market-based policies, it is economic incentives. Economic incentive. Okay. What is the incentive for a market? What is your incentive in the market? Make profit. If you're a producer, if I am a producer, what is our incentive? Maximize What is your incentive as a CA student? Pass. Maximize your mark. Maximize your returns. Maximize your life happiness, satisfaction, isn't it? So these are the marketing sectors. So price acts as a signal, and so this is a very, very clever form of government intervention. Market-based, I feel you can write a little extra, like, okay, even though I will be conforming the textbook, I have no time to explain too much. So that's why we are, exam-oriented teaching, right? This is a very, very clever way of government intervention. You know how antivenom is produced from the poison of snakes, isn't it? You know how anti-rabies vaccine is produced. Like this, in order to correct market failure, government is using the market forces. So what is the primary thing in a market? Prices. Okay, prices. So any market-based policy would be using prices as an instrument, right? That private firms are having, incentives in the market, incentive to reduce cost, incentive to make profit, incentive to, charge higher prices. Market incentives are there, that ability to take advantage of market forces. So why do I say this is a very clever idea? That is, private firms can be confronted with the same kind of incentives which they face in the market. The very same kind of incentive which they face in the market. For example, when they hire labor, when they call people for employment, when they buy raw materials, when they buy, electricity, power, fuel, right? Business people will be so much bothered about the prices of these inputs, right? They are so much bothered about the prices that they will always try to economize. What is economizing? They will always try to reduce cost by paying less salary, by paying lower prices for the raw materials. They try to economize. And they have signals. Price is a signal. Price of the product is a signal. Price of the factors is a signal. So this powerful advantage or signal of the market in the form of prices, that are utilized to create environmental quality. That is to service the environment. That is to solve the negative externalities which will affect the environment. So I repeat, market-based approach or market-based policy is using market itself. So what is it? In other words, it operates through price mechanism, or it affects the prices that the firms can charge. It will increase the prices that the firms can charge. When price increase, they will have to suffer the consequences. Demand and supply decide the price normally. And profit is decided by the prices that they can charge. If prices increase and demand falls, they are not able to survive in the market. So that is why, I repeat, they are using economic incentives to accomplish, to accomplish the environmental objectives. What is the environmental objective? Clean air. So how can you make clean air? Please note, these interventions are found out by economists. economists are the ones who have found out these. There are many economists whose names are associated. And so let us go to, directly go, environmental taxes and cap and trade. Some of you might have read the textbook. I'll be explaining that is environmental taxes. So it is a tax for supporting the environment, protecting the environment. So how do taxes affect the price of a good? The price of a good is definitely cost of production plus taxes. So taxes affect prices directly, right? And so this is a direct method is, then the second method is, indirect. I repeat, taxes increase price. When price is increased, you are forced to reduce supply. You can only produce less. When you produce less, there is less pollution. When there is less pollution, there is better environment quality. See how price mechanism works. So price is directly used to reduce pollution. Now, a tax incentive program, that is what in Western textbooks they do. That is, the tax is, the person who is conserving the environment. The person who conserves would pay the least tax. So the tax is placed until the desired, pollution levels are achieved, the people have to pay taxes. You are polluting more, you pay more taxes. So let's come to the concept of Pigouvian taxes. There are lots of concepts. We have taken only one concept. That is Pigouvian taxes, named after A.C. Pigou, great economist. So make the polluter pay. If you're polluting, you are responsible for polluting. You have to internalize it. You have to pay for it. So that is internalizing the external cost. Internalizing the external cost. What is the meaning of internalizing? You remember yesterday private cost I was mentioning. In your language, private cost is an accounting cost. You write in your book of accounts. External cost is something you never write in your book of accounts because it is not your the producer's cost. So what is the objective? That is external cost. Please note it. External cost will be made accounting cost, right? So that is the meaning of internalizing. You incur an external cost, okay? You don't incur the external cost and walk smart. No, you have to internalize it, or you have to adopt it on yourself. You have to bear it. And so, if you make pollution, you will pay pollution tax. If a producer or one who is creating externality, let them pay the tax. And so what happens? The tax is very painful, isn't it? I have to pay the taxes means, all consequences of taxes. My prices will increase, demand will fall, right? Demand will fall. When demand falls, I can only produce less. When prices increase, I have to face all problems associated with, survival in the market. So let us now go to see how Pigouvian taxes, a diagram, a very simple diagram. Pigouvian taxes can be used to internalize externality and create or produce a socially optimal level of output. Yesterday we have seen that negative externalities, I am using the same figure you remember yesterday, that is negative externalities. This is marginal private benefit, which is the same as marginal social benefit. Why marginal? In your book, I think it is only a social benefit that is written. It is marginal private benefit also. What is the meaning of marginal private benefit is the same as marginal social benefit? There is no externality in consumption. We are coming to that at a later point. There is a marginal private cost. Marginal private cost. Any producer would produce market QM. And this is the price market will produce because they are interested only in their private, private cost and private benefit. These are actually demand and supply curves. For those who did not attend the classes today, marginal private benefit is the demand curve. Marginal private cost curve is the marginal cost curve, which is also the supply curve. And so I draw another curve, marginal social cost. What is marginal social cost? Marginal private cost plus marginal external cost. So this is the cost to the society. So if this is equilibrium, actually private cost is only this much, but the social cost is this much. I will not complicate the diagram, okay? Right, it is already there. Now this portion in your book, it will be given some notation. I think it must be ABC. Right. This is the welfare loss because marginal social cost is not covered. Right. And what is the solution for this? To tax, impose Pigouvian taxes. Right. Please remember, sometimes this marginal social cost will be parallel. Like in some books, we should not be misunderstood. In some books, marginal social cost curve will not be parallel. It will be like this. Reason is, as output increases, the proportion of, chemicals or emissions increases disproportionately. And you don't have to worry much about it, economic students, if you worried about that. And so this is it. So what can be done? Just put a pollution tax. A pollution tax, a per unit pollution tax. I will make it a little more relatable. Okay. Okay. This is MSC and marginal cost. So put a tax. So this much is the tax. Please note it. This much is the tax. So this is MPC and this is tax. So this will be MPC plus tax because cost tax is always a cost. You have to pay the tax, isn't it? Tax will act as a cost and now MPC plus tax. Right? Now MPC plus tax is equal to marginal social benefit. This is the point. That is marginal private benefit is equal to marginal social benefit. And so this is the marginal social benefit. This is the marginal social cost curve. They intersect. Yesterday, you remember, optimum is MSC is equal to, come on, marginal social benefit. So marginal social benefit is equal to marginal social cost at this point, and output is reduced. After the intervention, output is reduced. Now this is socially optimal because this point represents MSC is equal. And what is the price? The price after intervention is definitely higher. Producers will not be happy. Definitely they will not be happy. But we could get them, internalize it, put it as accounting cost. Along with the cost of land, labor, capital, organic, and not in your say that is direct cost, direct material cost, and all those costs, this also falls as a cost to them. So that normally the supply curve will shift to the left. This is supply curve has now shifted to the left and the price charge is higher. So whenever there is negative externality, you remember yesterday, there is too much of production and price is less. But now we have the right quantity of production and the right price. Okay, so tax has acted through price mechanism. Tax have, it is a tax is placed on the externality, and so it is influencing the price, and that is why this is a price move. So internalizes the externality by making it an accounting cost. Now the accounting cost is not marginal private cost, it is marginal private cost plus tax. So this was the supply curve. Now this is the supply curve. This is the demand curve. Here intersection of demand and supply curve. We call them marginal social benefit and marginal social cost, right? And so it is this way you can solve. Right. Now external cost now gets borne by the producer. But there are lots of problems. It is clearly given in your book. You can go through it if your book is open. There are many problems. You know, how will you measure the exact tax? How will you find out? It is a very complex procedure. You know, it is very difficult to determine and administer. That is the sentence given in your book. How much is the pollution? How much should be the tax? Very difficult, isn't it? Of course, in Western countries, you know, now this pollution, there are computerized systems by which, you know, the carbon emissions are measured and reported to the pollution control agencies. Oh, but in a country like India, it is simply, you know, lot of administrative procedures. Somehow this is only an incentive, but some people will think, okay, let prices go up. For some producers, they can sell even if prices are high. Who are those producers whose products have inelastic demand? What is inelastic demand? Even if the price is higher, the responsiveness of quantity will be less. That is, they can sell the same quantity, more or less the same quantity, even at higher prices. Take, for example, the price of milk. Inelastic demand. Even if the price of milk is slightly higher, you know, but people will buy more or less the same quantity. People don't respond. That is the meaning of inelastic demand. So if your product has inelastic demand, definitely you don't have to worry about taxes. You can always shift the taxes. Okay, impact, incidence, lots of economic theories are there. The tax, where it will fall and where it will finally go to. The producers can shift the tax and be very happy, right? Then this will not work. And if your pollution taxes are very high, you know what will people do? They will shift their production. That is why, you know, capital flight from one country to another country. We'll be learning that in the last unit. Why do people come and invest in another country? Because the pollution standards in their country is so high. Emission standards are so high. Emission taxes are so high that they find it always profitable to take their capital and go to another country or another state or another place. So that capital flight is a possibility. So one has to be very, very careful, you know, balance out. That's why pollution taxes are very difficult to work, but it is working in many cases. Now, I hope it is clear. We are now learning the market-based policies. The first market-based policy is pollution tax, also called Hungarian taxes. This question is asked a number of times. Please learn to draw the diagram. It is very simple. First you do the market, then draw the marginal social benefit. With that, on that intersection point, just draw a tax line. That difference is the taxes. It goes like that. Okay. Now please learn it today itself. The second one is to be very attentive, because this is something very interesting. Every day, you know, it comes in the newspaper. Tradable emissions permits. Tradable emissions permits. From the very word tradable, it is a permit. A permit is definitely earlier, you know, when we were younger, you know, permits used to be on piece of paper. but definitely this will be electronic. So it is a permit and it is an emission permit. You are permitted to have emissions, and this permit, once you have, you can trade it. So when you trade something, there is a market. Trade takes place between two people, isn't it? A buyer and a seller. So there is a market for emission permits. That is the theory. So what is it that we are learning now? Market-based policies, isn't it? So there is a market for emission permits is created. A market. And let's see how it works. It is also known as, in US, it is known as cap and trade. Cap and trade. What is cap? Maximum. Cap is on our head, isn't it? Cap is the maximum. Decide on the maximum permissible pollution and then grant permits. There is a generic name for this. In newspapers, it is usually written as carbon credit. Kyoto Protocol, carbon credit. Now we know that India is facing the problem of, having a lot of carbon credit in our pocket, unable to sell. All that you read, understand, it is, once you know economics, you will enjoy reading and understanding what is the basic problem, right? Under Kyoto Protocol, India has got a lot of carbon credit, but cannot sell because nobody wants it. Right. Let's see how it works. Now, this cap and trade or tradable, I'll be using the word tradable emission permits. Okay. It provides a lot of incentives. Incentives to internalize. Because if we don't internalize, you're going to get into trouble, right? Not because we are happy, but we are forced to. The producers are forced to. So the government, it can be a government or a pollution control agency or whoever it may be concerned with the environmental protection, it will sell, permits. As I said, carbon credit, that is a right to emit. If you have one carbon credit, you can emit 1 ton of carbon. Okay, 1 ton of carbon dioxide, or if you're not emitting carbon dioxide, it can be, equivalent, something equivalent to carbon dioxide. Maybe you're emitting sulfur. But 1 ton worth of emissions is permissible. Carbon credit is expensive, right? Its price can vary. And so you buy this carbon credit now this is a marketable license to emit quantities of pollutants, and this is marketable means that you get. This is how the system works. I will make it a very simple presentation. That is, suppose there is a leak. Zero pollution is not possible. Zero pollution is not possible because even if you breathe, or even if you produce a very simple something very simple, a toothpaste or something very simple, pollution will definitely. So zero pollution is not possible. So suppose there is a lake or environment or whatever it is. The polluters are not bad people. We have to appreciate them. You know why? Because they're producing goods and services for us. Unless they produce goods and services, unless they produce laptops and computers, how are we going to attend this class? Unless they produce mobile phones, highly polluting industry, how on? So some type of pollution is inevitable. We have to accept. We need to minimize definitely, but we have to accept a certain level of pollution. Suppose there are industries, 1 industry, 2 industry, 3 industry, 4 industry, like that. There are industries around. So we decide, this is the maximum amount of pollution that we can accept. Suppose we put it in number 500, whatever units. I'm not good at science, so 500 is the permissible pollution, so that the people in the lake will be alive and lake would be comfortable. We permit, okay. 500 pollution. So this is a big industry. You divide this, so we sell, say, for example, 495 permits or 500 permits at the time being, say, okay, this is a big industry, we will, this industry can buy 200, this can buy 50, this can buy 50, this can buy 100, so 200 plus 300 plus 400, this can buy 50, and this can buy 50. So the industries which are polluting will buy these the total amount cap. The cap is, it is split into allowances. The cap is split into allowances, and so this company can produce 200 because it's big. This will produce 50. This will produce 100. So it is split. Happy, everybody. Okay. So everybody can. Government permits you. Okay. And if you are a producer, okay, this man who is producing, he has three options. Every single producer has three options now. Okay. Now, meet the emission target because you hold only 200 permits. I said it is tradable, isn't it? So, meet the emission target. This one creates 200 pollution, 50 pollution, meet the emission target. And you have already spent money for 200, 250, 50. Okay, meet the emissions target. You can do anything to meet this target. Maybe you want a complete overhauling of your machinery, and that means cost before. Okay, or you can change the production process here. You can change the product here. Okay, that is, you are producing soap. Now you decide you are producing something else. This is a plastic firm which decides if I stop production or the process which I produce plastic, I will change. Okay, I can do anything and conform, meet the emission target. Or if you are smart enough, reduce the emission target. Okay, you reduce it and use only 150 permit. Right? You are allowed 200. You use only 150. And then, these people are not so sophisticated. You are sophisticated, so you can sell 50 outside. When you sell 50, money will come to you. And these people lose money because they are more polluting than you. And when you sell the permits that you have, you get money. You get money is like just like income, right? And you become smart, right? And all those people who are polluting, this plastic company cannot remain with 50 permits. It wants 65. They will buy from you. So there is a market for emission allowance, right? There is a market for emission allowance. Those who are, what is the firm's incentive? Reduce pollution or run into trouble. Because once you don't reduce pollution, I hope I am communicating, once you don't reduce your pollution, you have to buy permits. Buying permits is cost escalation. You know what is meant by cost escalation? You remember, your cost goes up. Your cost goes up means, product becomes less competitive. You can't survive in the market. Right. So this is how market mechanism is used to solve the problem of market failure. So those smarter firms, they will cut their pollution, or there are two choices. You can either cut your 10 to 50 or keep it separately. In future, if you are making pollution, that is the meaning of banking on it. Keep it. Right? Now, as a firm, if you are the producer, what is your incentive? Buy credit, buy permits or sell permits. Your incentive is to buy the minimum number of permits and try to sell the maximum. So that is the least expensive approach, isn't it? Reduce your pollution and try to sell the pollution permits to other firms which want. The high polluters will have to buy more permits, right? They become less profitable. The low polluters receive revenue. Okay, the more low polluters can sell and get money and put in their pockets, and they receive revenue. The most surprising thing about it is that, okay, you are permitted to discharge more. There is no compulsion. Okay, you are permitted to discharge more. This firm want to discharge 50. Okay, do that, but you have to buy first. So you have to face the market. The market. Now this is cap and trade. I hope it is clear. That is, have a cap and then allot the pollution permits, and then those who are the lower polluters can make money by selling those who are high polluters. So what is your incentive then? This is a very efficient system, isn't it? The government need not always think of legislation, right? It works automatically. Everything market works automatically. So this is less government intervention. This is associated with many economists in the US. Less, this has been a very, very efficient. It is a very cheap to run than right number of permits. So we have, for example, in India, in 2019, I think Surat was having 8 times more than World Health Organization standard of tiny particulate matter. Okay, TPM they call it, tiny particulate. So we have, now don't think that this is a story. It really works. We have in India also, we are also trying this. And in the US, lots of, that's given in the US also, lots of achievement of environmental cleanliness, that is purity of air has been. Now this is the second market-based approach. Now both markets and cap and trade. Now the next question that can come is compare cap and trade with the pollution tax. Cap and trade is more popular because the total amount of pollution is fixed. This is the maximum you are per. Okay, total pollution is fixed. That's not given in the book. Noted. You do not know who is polluting, where it is coming from. We do not know. We are uncertain about where it is exactly coming from. But pollution tax, there is an uncertainty about the total amount of pollution. You pollute more if you are willing to pay more taxes, right? You pollute. Usually, more than regulation, that is, of course, market-based approaches are good, but when there is a COVID-like situation, definitely the government has to act immediately. So that the second approach is also over. Now we go to the third one. Come to positive externality. How will the government intervene when there is positive externality? Right. Positive externality. Positive externality is, come on, positive externality is the society benefits, the third party benefits more than the private party. So please note, whenever there is positive externality, this is marginal private benefit is less than marginal social benefit. This is marginal private cost, which is the same as marginal social cost. We assume like that because this is the only way we can. Okay. So remember, marginal private benefit is less than marginal social benefit. Marginal social benefit is more, marginal private benefit is less. Okay. And marginal social benefit is greater than marginal private benefit. Keep it in mind. So what will, now government wants to encourage consumption of goods. Yesterday, you remember education, healthcare, consumption, medical checkup, vaccination, inoculation. government wants to encourage, consumption of goods which have positive consumption externalities. There are 30 explanation, positive production externality, lots of diagrams are there, but we are taking only one or two examples because the scope of our unit is only that much. So we have what is known as corrective subsidy. Corrective subsidy. It can be given to the producers, part of the cost will be met by corrective. It can be given to the consumers, right? The consumers, because, and we know the demand curve does not reflect the positive externalities. If I am buying education example given in the book, if I am buying education, it is my marginal private benefit. If you become a chartered accountant, marginal social benefit is there. This is the externality, right? So if government is not there, okay, this is the way, okay, if government is not there, demand and supply intersect, the price in the market will be this much and the quantity in the market is this much, okay. So what is the loss of external benefit? This much of external benefit is lost to the society, okay. This much of external benefit is lost. And what is social optimum? This is the social optimum. What is it? MSC is equal to? So for each unit of education that is not purchased by the society, this is the dead weight loss. Please remember, always dead weight loss triangle will point to the optimum. This is optimum, MPC. So that you will not make a mistake while showing. Okay. This is the dead weight loss. Okay. So what is it? When there is positive externalities, there is underproduction. Okay. There is underproduction. This is optimal production. But we are producing only this much when optimal production. This much of underproduction. Underconsumption. Loss of social welfare. Now, what will the government do? Here, the government will intervene. How will the government intervene? You have to draw a separate diagram. I am using the same diagram. Okay. How will the government? I will draw separate. Right. Okay. Now, positive externality. Consumption of goods which have positive externalities will have to be encouraged by the government. How will the government ensure that? Okay. Marginal private benefit, marginal social benefit. Okay, this is marginal private cost and marginal social cost. This is the optimum, right? This is what market is going to produce, right? This is the loss. Now the government, I'll go slightly faster. The government will provide this much of subsidy. A subsidy equal to the externality. A subsidy that is equal to the externality. That means students who are attending a particular course or people who go for education get a subsidy. A subsidy is like an income for you, but you can use it only for education. You can't use it for buying cosmetics, right? So the subsidy is available for education. Now, when subsidy is given, what is your incentive, right? My cost of education will be lower, isn't it? Subsidy, a part of my cost will be met by the government. And it is like I become richer, okay? So that my demand curve, that is marginal social, my demand curve will shift to the right. Right, simple theory. When I become rich, when a part of my income is boosted by a subsidy, the demand curve will shift up. That's why it is marked D in your book. The demand curve will shift up. There will be more demand for education because government. Okay, right? More demand for education. Now, what happens is the marginal private cost, marginal social cost, because there is no externality. Now we have optimum. I'm clearing this. We have optimum for socially beneficial. This is the price of education in the market. This is the quantity of education is left to the market. This is the dead weight loss. Now please note, we have now increased the quantity of education, optimum quantity. But you must be worried because the price of education is now more, isn't it? Earlier, the price of education was already this much, the price of education now is more. That is the right price. But as students, you don't have to worry at all because what you pay is only according to your marginal price. Please note it in your book. This is what the students pay. The students pay only this much. In fact, the price is reduced for the student because this much is given as subsidy by government. It is given as an arrow in your book. This much cost of your education. Actually, the price is this much, but you pay only this much, and this much will be met by the government. So it is given as a subsidy by the government. So see how subsidy will shift to the marginal social benefit. So corrective subsidy for education will ensure that the demand curve for education shifts to the right. More people get education, but a part of the money will be met by the government. You pay fees according to your margin and your demand, but government will give you subsidy. And so educational institutions don't have to worry. They will get this much money, right, per student. But the student need to pay only this much. So that this subsidy will ensure that the right quantity of education which has positive externalities. Okay. Now the next topic is about positive externality. I am going slightly fast. Positive externalities in production. The same thing happens. What is a production subsidy? A production subsidy is like this. Suppose your cost is 10 rupees. Government will meet 4 rupees. Okay. Now what is your cost of production? What is the price at which you can sell plus 2 rupees profit? You can sell it at 8 rupees. Okay. That is, a subsidy will reduce your marginal private cost. I hope you understand. A subsidy will reduce your marginal private cost. You are happy when your cost decreases, your supply curve will shift to the right. Increase in supply, reduce the price, and when price is less, more people will consume this good. You can produce more. Right? So, corrective subsidies can be either production subsidies or consumption subsidies. Whatever happens, a subsidy will lead to higher output in the case of positive externalities. For production subsidy will also lead to higher output that will ensure optimum. Right? Okay, optimum production is ensured by a corrective. I hope it is clear. Now we have discussed what are the things that we have discussed. Market-based policies, then giving of a subsidy. That is all. A subsidy is also a market-based policy. Why do you call a subsidy a market-based policy? Because it is affecting prices. Whenever prices are affected, we call it a market. Now we go to merit goods. Merit goods are also, goods or services which have substantial positive externalities. Okay, people do not consume usually sufficient merit goods. There are two ways government can ensure. It can legislate, pass rules like people should take compulsory insurance because insurance is a merit good. Children should be given immunization. Helmet and seat belt should be worn. COVID vaccination should be taken. Universal primary education should be there. All these legislations are also possible. Second thing is that when it is so much, subsidy, of course, the same solution you can use, same diagram you can use for merit goods also. But suppose sometimes government, why is that the government is running schools? Why is that the government is running hospitals? Because these have so much of positive externality. It will be provided. You don't pay anything. Yeah, poor people don't pay anything in the government hospitals. That means it is provided free of cost. Right? The government will establish certain quantity of merit goods. This is the supply of merit goods. Let it be hospital service. And government says that, okay, if it is left to the market, this is the demand curve, that is marginal private benefit curve. People who have money can afford it, and this is the price of a medical checkup you have got to pay. But suppose you give it free, here price is 200 rupees. Suppose you give it free, zero. For example, COVID vaccine. This much of COVID vaccine is available. This is the demand for COVID vaccine. If price is to be paid, many people will not go for COVID vaccine, right? But if it is given free, that is at zero price, please note, zero price, demand curve is here. That is, there will be more demand than supply. That is a big problem, isn't it? Almost all people are going. Okay. So merit goods would be, socially undesirable quantity of merit goods, socially desirable quantity of merit goods will not be produced. So government has to produce and give, but this problem is there. Okay. Then we go to demerit goods. Demerit goods. What is a demerit goods? A demerit good is one that is not good for me, one that is not beneficial for people. Then you will ask me why people are buying this demerit good, even if it is not beneficial to them. We do not know. We don't have knowledge. We are careless, right? There are lots of negative externalities. Example given is alcohol, intoxicating drugs. There are so many, we call it in economics, that is, economic goods are, that which is good. We call it economic bads. Okay, economic bad. There are so many things which are not good in the economy, happening in the economy. It is there. You cannot prevent. Why? Because consumers feel, sometimes they overvalue. I have heard people that drinking alcohol, saying that drinking alcohol will make the workers more energetic. They do not know. They have imperfect information. Then the government, based on research, the government will intervene. How will the government intervene? Total ban. Many methods are given there. For example, alcohol, the price of alcohol will be increased. There is a lot of advertising. Have you seen the cigarette packet? What is written on the cigarette packet? A person who sees a cigarette packet would never smoke cigarettes, isn't it? So legislations, then children below the age, so much of age, below 18 will not be given such and such things. Lots of regulatory control. Smoking in public is banned. Then very high taxes. So like that, lots of controls are usually there. Then tax is a market-based method by which tax is a market-based method by which you can reduce. When alcohol is 300% taxed in my place, that means the drunkards really pay quite a lot of money to the government. That will discourage consumption is what people think, but that will not discourage consumption because alcohol is a habit-forming commodity which has inelastic demand. So what happens is they reduce the consumption of other goods and go and buy. So how far taxation will work in order to reduce the demerit good is questionable, right? Because it has got inelastic demand. Then minimum price setting is what is given in your book. You can open your book and see minimum price setting. In the case of a demerit good, you overestimate your marginal private benefit. The marginal social benefit is left to the marginal private benefit. Marginal private benefit is more, but as far as the society takes the case of alcohol and drug, marginal social benefit is less. And this is the marginal social cost. We assume that is the same as marginal private cost. Okay? And so left to the market, how much will be produced? This quantity QM will be produced. But what is optimal? Optimal is QO. What is the condition of QO? QO is optimal Okay. QO is optimal because in the new edition I need to check which diagram is given. Yeah. So the price, same diagram. The price is this much. This is the market price. But what is the optimum quantity? Right. You fix a price in such a way that a price is fixed. For example, which is government determined price, PG. This is higher than market price. Okay, it is higher than market price. So what is the incentive of person who is buying? This is, say, for example, 500 rupees. Market price is only 300 rupees. What is the incentive? Look at the marginal private benefit curve. This is the demand curve, and the demand curve intersects here, isn't it, with the price line, and this is what will be on. And you can find theoretically optimal quantity is ensured. I hope it is clear because of time constraint. So the price is kept substantially higher than the market price. Okay, that takes us to from demerit good. My time constraint is definitely there. That takes us to the next, that is what are the limitations you read in the case of public good. Of course, I need not discuss because that is the next topic you had in your book. For example, public goods have to be provided by the government because of non-rivalry, non-excludability, positive externalities, and some goods have to be provided. Why is that? For example, certain activities are reserved for the government. Protection of certain activities. Some activities are so dangerous. For example, the example given in your book is, airport safety. Right. It cannot be left to private, isn't it? Then atomic energy, it cannot be left to the private. Right. With that, I think there are two more diagrams in the book, that is price floor and price intervention, non-market pricing. What is non-market pricing? Price is usually decided in the market. When price is decided somewhere else by another agency and not by the market, we call it non-market pricing. Okay. There are two ways in which non-market pricing is done. Either a price floor floor is bottom, isn't it? Right. Price floor, that is minimum price. You know, agricultural products are given minimum price, minimum support price. Have you heard about it? Minimum support price. Minimum wage. What is minimum wage? If there is no minimum wage rule, you know, what people will do is, you know, the people will exploit, isn't it? Right. So especially when there are more number of laborers to work, and suppose this is the market wage is only 200 rupees per day. Market wage is only 200 rupees per day, and so the government is not happy because this number of laborers will get employed, right? Because this is a given wage, demand and supply will decide the wage of laborers. Okay. Government is not happy because nobody can live with 200 rupees a day. So that government says, okay, minimum wages should be 400. That is a price floor. Minimum wages or minimum support price for sugar cane this much. And what will happen is, you know, we study Western economics, which is very heavily linked to market economy, right? That's why what happens is, when price is this much, the demand for labor is only this much, but the supply of labor is this much. Because this line touches the supply curve here, at higher price wages, more labor would be supplied, isn't it? More women would like to work, more people would like to come and enter the labor market. And demand is only this much. Why demand is that much, only that much? Because higher wages, you will always reduce the number of people who you employ. And so there is a mismatch between demand and supply. So people will lose employment. Okay, that is the argument. People will lose employment if minimum wages and minimum support price you keep. Okay, but you know, demand will be less. Demand will be less. Excess supply will be there. Excess supply of tomatoes will come. It has to be procured by the government. Excess supply of food grains will come. So this is one theory, market outcome. And suppose there is a maximum price that is set. In 1980s, I remember there was a terrible sugar shortage in our place. Okay, not only in our place, I think in your place also. You were not born at that time, so you know. So the market price of sugar was very high. Okay, 35 rupees at that time. That was very high. This is the supply, this is the demand. And so the government said, nobody will sell sugar more than 15 rupees. Clear, ceiling price, maximum price that can be charged is 15 rupees. What will happen? All suppliers are willing to supply only this much. But we like to have more sugar in our coffee and tea. We like to make more sweet because sugar is cheap. So there is a gap between supply and demand. Clear, demanders are more. So there will be a shortage in the market. And where will this go? You know, suppliers will create a black market, and those who really want sugar, you know, they will get sugar at a higher price or even at a higher price because their black market will develop. So like this, there are hundreds and hundreds of things, price intervention. Then the rest of it you can read and understand. For example, for asymmetric information, lots of application questions will come. What is the purpose? For example, a label on a food packet. What is the purpose? Information. Insurance companies ask you to write down so many things. Your health is free. Go for a physical examination, right? Okay, that is because asymmetric information there. Right, to get information, right? Then there is another technique, isn't it? Exemptions, exclusions, right? That is, you go to a hospital, insurance company will put maximum of certain. They will exclude this. That means you have to bear. Car insurance, they don't cover certain things. So you will be careful while you drive it because your pocket will also be affected. That is to prevent moral hazard, right? To prevent asymmetric information, insurance companies have many methods. Okay, we have consumer report, product reviews. You buy a bedsheet online, immediately you ask what is the probability of your recommending. Okay, before we go for a movie, we watch the review, isn't it? Then franchises. Pizza Hut, for example, when I say Pizza Hut, oh, you think it is something. So such franchising, brand names, then professions wander. Doctors, say for example, chartered accountants, every year you have to re-register, isn't it? And conform to certain standards, CPE, hours, okay, like that. Then products, vegetarian, non-vegetarian, kilocalories, nutritional information, then statutory information is to be, okay, for example, licensing of doctors. You need to get a license to practice. If you want to teach in a college, you have to pass national eligibility test. All these. Then for credit information, whether you are credit worthy, please keep scribbling it because application questions can come. If you're credit worthy, CRISIL, okay, credit worthiness of the company, rating companies are there. Correct. Then for individual credit worthiness, CIBIL is there, isn't it? Banks can always check whether you are right. So like that, hundreds. For commons, you remember Delhi roads, road rationing was there in Delhi, isn't it? Rationing of roads for such and such purpose. So that is the way we are solving. For example, anything that you read, please note which problem is it that we are trying to address. Is it asymmetric information? Is it moral hazard? Okay, like that you can document procurement, right? So I think we need to go to the next. Before that, you can take a 4 minutes break, okay, and come back, please. In the meantime, any question, because fiscal policy is also quite long a lesson. I need 1 hour plus. Thank you for your patient listening. I think I was a little taxing, right? It's okay. Okay, take a break. go to the next topic, that is fiscal policy. I don't see any questions. I don't see any questions. Yeah. Good evening, morning, good evening. Right. Okay, welcome back. It is slightly taxing, I know, but we go back. I hope students have come back. And so we have discussed market failure, then we have discussed government intervention to solve all four problems. That is for market power, externalities, what to do with public good, right? Positive, negative externality, public good, asymmetric information, adverse selection, moral hazard, and what to do with the free riding problem and common resources problem, right? These are common resources. What are the methods? A few more additional points will be nailed by me because every single point could not be covered. Okay. Some application questions. Now we go to fiscal policy. Just 45 minutes I will discuss. And then if you have any doubt, because fiscal policy is something, if you understand, there is absolutely no problem answering any question, right? What is fiscal? First of all, understand the term fiscal comes from, Greek, Latin, and all those English background, from the word fisc, F-I-S-C, or fiscus, etc. Different names there. Fiscal stands for, fiscal refers to the purse of the government. Okay? The purse of the government. The exchequer, the treasury of the government. So anything, suppose this is the treasury of the government. Anything that relates to government money or public money is what is meant by fiscal. As you know, we are now talking about government intervention for stabilization. You remember fiscal functions. The third function was government intervention for stabilization. So we are moving from microeconomic, that is allocation function and redistribution function, to stabilization function, which is a macroeconomic function of the government. So there are two types of policies that governments follow. One is fiscal policy and the other is monetary policy. Monetary policy comes in chapter 3 as unit 3. It will be taught later, but fiscal policy will be taught now. If fiscal is concerned with the treasury, monetary policy is concerned with the money, the amount of money, the availability of money, the access to money, the supply of money. That we will not learn now. So, government, so treasury is concerned with, so public finance is concerned with three things. Please listen carefully, because once you listen, you won't have any doubt. Money comes in. How does money come? Through taxes. That is, you talk about the income of the company. Money goes out of the treasury. That is expenditure of different types. That is current maintenance expenditure. Then capital expenditure is there. Transfer payments. Transfer payment I've done in chapter 1, unit 1. Transfer payments are payments made to someone without getting anything in return. If someone is getting pension, it is a transfer. No contribution is given in return. So the second is government expenditure. So income and expenditure of the government, as you know, government is a huge entity entrusted with a lot of tasks. So sometimes income may be less than expenditure. In that case, what will the government do? They will borrow. Okay, that is the third part of it. Borrow money either from internal sources or from other sources, external sources. And so these three things form the subject matter of fiscal policy, what we learn. So by changing the level of taxes, that is income prospects, by changing expenditure or by changing borrowed amount, right, you can actually, this is public finance. When you manipulate, what is the meaning of manipulation? Don't think it is like check manipulation. Manipulation only means, change in such a manner that you want to bring some outcome out of it. You change it so that there are some desired goals that you want to attain. So you manipulate income of the government, expenditure of the government, and borrowing of the government. Finance turns into fiscal policy. Public finance is concerned with income expenditure and borrowing. But the moment governments use this as a policy, okay, as a policy to attain certain desired goals. What are the desired goals? Aggregate economic activity. Chapter 1, Unit 2, you have learned all this. This is very much connected with Unit 2. You need to have a thorough knowledge of Unit 2 in order to understand this chapter. Okay, this unit. So there are, aggregate economic activity, total output, total employment, general level of prices, economic growth, equity, redistribution. All these things are supposed to be, a desired objective of all these things, right? So the manipulation of government expenditure, right? That is purchases and transfer payments, government investment and so on, taxes, borrowing, in order to positively influence the economy, in order to attain certain goals. And that is fiscal policy. That is just a policy concerning the state treasury or the government finance, how you adjust that in order to government's expenditure and revenue in order to attain certain objectives. Objectives of fiscal policy is given in your book, usual objectives. For example, differs from country to country. What you usually do, that is provide stability of prices, maintenance of full employment, could keep inflation, because India's monetary policy is for inflation target. Keep the inflation lower, ensuring equitable distribution of income, making sure that economic growth takes place, making sure that economic growth with equity takes place. Hundreds of objectives there can be, but these are the major objectives. But sometimes these objectives will conflict. For example, equity and growth, they conflict. Of course, if you stress too much on equity, redistribution takes place so fast that, rich people become very bad, very, very unhappy. That is why our finance minister says we respect the wealth creators. The wealth creators should not be discouraged. Okay, some incentives should be given to corporates as well. Clear. So equity and growth are conflicting. So if you want too much of equity, socialistic objective, growth will suffer. Inflation and unemployment, these are conflicting objectives. Because if you can afford to have a little bit of inflation, employment will be more. Okay. If you can't tolerate inflation, employment will be less. All that is pure economics. Now, fiscal policy came into prominence when Great Depression of 1930s. After that, trade cycles took place. For example, we know about the global recession starting with the US, which happened in 2008. The possible recession that we are now facing, right? So now even a country like US, which is always saying that market is very powerful, they are thinking and acting in terms of government intervention into the markets, too much of government intervention in the market. So let's learn a little theory. When there is recession, go to Keynesian theory. When there is recession, what is the problem? What is recession actually? Recession demand for goods and services. Why is that we don't have demand for goods and services? Because people don't have money. Why is that people don't have money? Because people don't have employment. Why is that people don't have employment? Because production is less. I mean, producers have cut their production. Why did producers cut their production? Because there is no demand. Why is that there is no demand? Because people don't have money. You see the vicious circle. People lose employment, their purchasing power reduces, they purchase less, inventories pile up. There are two paragraphs in your Keynesian theory like this. Inventories pile up. It's macroeconomic. Overall sales, you just cannot sell everything that you have produced. And so what will happen? If you cannot sell next cycle, what will you do? You will produce less. When you produce less, what happens? Employment is, some people will go unemployed. When some people go unemployed, they don't have money. When they don't have money, they don't purchase. When they don't purchase, inventories pile up further. Sales will get reduced. When sales are reduced, you know what happens is, back home, producers cut production. People lose employment. People have less money, right? And that is during recession. So unless some action is done, say for example, recession is a declining portion of trade cycle, isn't it? Recession, declining portion. If governments do not intervene, it will become a depression. So government has to do somewhere here. Intervention by the government during recession is put more money into the hands of people. The whole set of fiscal policy measures is given. During COVID, what are the fiscal policy measures is given as an annexure in your text. What is the objective of each such policy? Put more money into the hands of the people so that aggregate demand can be sustained. People will demand goods and services. And when aggregate demand is sustained, production will be sustained. If production is sustained, employment will. If there is employment, there will be income. If there is income, demand will be coming forth. That is how economy will recover. It will not go to depression. It will recover, and it will recover. So put more money. Please remember, during recession, put more money into the hands of the people. So any fiscal policy, that's what I said, easy, very easy now. If it is recession, what should be the objective? Put more money into the hands of people. Put more money into the economy so that aggregate demand is sustained. What is the opposite? During inflation, there is more employment, as I said. During inflation, prices are high, When prices are high, producers are happy producing, they will employ more people, more raw material, more resources. Resource use is very high, right? Prices are rising, more people are running to buy goods and services, prices keep rising. So how to control inflation? Take money away from people. Take money away from people so that their purchasing power is increased. So put these two together. During recession, give purchasing power to people, give money to economy. Okay. During inflation, take money away from the pockets of people. You know what is inflation? It is too much money chasing too few goods. Money supply can increase overnight, isn't it? If Reserve Bank of India decides money supply will increase, but do you think goods and services will increase? Do you think wheat will increase? Do you think tomato will increase? Do you think air conditioners can be increased overnight? Do you think pencils and pens can be increased overnight? Clothing can be increased overnight. People will run with money if they have money, but goods cannot be increased all of a sudden overnight. So what is inflation? Too much money going and falling on too few goods. So each unit of the good would command a more number of units of money, and more number of units of money is the same as higher prices. Clear? So this is a principle in fiscal policy. You will not make a mistake in answering any question, because if you have this in mind, you know what should be done, right? This is the generic thing that is used. Now, please remember, not all fiscal policy is deliberate. That is what sentence given in your book. I hope that sentence is exactly that. That not all fiscal policy is deliberate. That means there are some fiscal policy which is not deliberate, which is automatic, which is non-discretionary. What is the meaning of discretionary? You apply your discretion and deliberately bring in some policy. And what is non-discretionary? It is not my discretion, it automatically happens. And that is, for solving a problem of trade cycle, there are two types of policies. One is discretionary fiscal policy. That is what is, that is, it is not automatic. The other one is known as automatic stabilizers. This question has come more than 3 times. Okay. Automatic stabilizer. Meaning of the word, it works automatically. Right? What is it working for? For stabilizing the economy. What is the meaning of stabilizing the economy? When there is economic fluctuation like this, you bring down the severity of the fluctuation. Have some measures by it, but it works automatically. I'll explain how it is. That is structural features. What is a structural feature? That is the way the taxes, the way the public expenditure is designed. Okay, our tax system. You are all experts in taxes, isn't it? You know about progressive taxes, you know about GST. You know, there is a structure of tax. It is designed in such a way that, you know, the structural features, that structural feature is used to smooth out. That is to reduce the severity of the trade cycles. So that is why it is known as built-in stabilizers. Built-in, it is built, it is already there, built into the system, built into the structure. It does not need any legislation. It does not need any announcement by the finance minister. It does not need any bill to be passed in the court. So whenever economic upturn or downturn takes place, that is instability, these fluctuations automatically, without any intervention on the part of the government, automatically this will adjust without any any deliberate policy on the part of the government. For example, I'll tell you, I'll draw a very simple picture, then it will be clear. Suppose this is the government regime, right? During recession, I'll cover it very fast. During recession, suppose this country has progressive taxes and government expenditure and transfer payments. So we take only transfer payment for the time being as government expenditure. Okay. Progressively graduated income tax, personal income tax, corporate tax, or direct taxes. Transfer payment is like this. During recession, incomes are lower, isn't it? Incomes are lower, and so the percentage of tax is also lower, so that only a small part, some people don't have taxes at all, or if at all you pay tax, you pay only a very small portion of your income. And maybe your employer has, TDS, tax deducted at source, and you will get some refund also because your income is reduced, your job is, your employer has reduced your salary by 20%, 30%. Okay. So what happens is the percentage. So this is your disposable income. The disposable income is not much affected because either you don't pay tax or you pay only a small portion. And the moment people lose, I told you, we learn Western economics, right? During recession, you can file for unemployment benefit. In different countries, it is known as different names. You file a request for unemployment benefit. Okay, you file a request for unemployment benefit, and then government gives you transfer payment so that your income is increased. This is the transfer payment portion of your income. Somehow your income is somewhat stable because you pay automatically. Government does not do anything, isn't it? Right. The system of transfer, the structure of compensation for people who are unemployed is kept like this, so that whenever you lose employment, you can file a request and get transfer payments. Okay. And so reduced taxes, increased transfer payments, this will ensure that your income is not much affected. So your effective demand, this is not about one person, this is about the entire economy. Right. All the people and all the corporates also have taxes, isn't it? All the people, all the corporates pay only a smaller percentage, a reduced percentage because it is progressive tax. And when people lose job, their income is augmented or increased by transfer. Automatically, your income is not much affected because the structure is like that. Okay. Now the opposite. During inflation, what will happen? Come on. You have very high income, right? Your percentage of taxes very high, 30%. Right? 30% tax. A substantial portion is taken away by the government as taxes and no transfer payment. That means your income remains more or less the same, isn't it? Okay. And so this is during recession. What is the tendency? That is, government, where will the money come from? During COVID time, you remember how much the government has borrowed from different places, isn't it? And so the government will borrow money, run into a deficit, and give money to the people. During inflation, government will have surplus budget. It will not give transfer. It will have more money because more tax is collected and less payment, less expenditure. Okay. So during inflation, higher taxes, lower welfare. So this is how automatic stabilizers work. I hope it is clear. That is, the structure is so kept. So for that, very intelligent tax structuring should be done. Very intelligent transfer policy. Very intelligent way in which in which the budget is managed should be done. But automatic stabilizers, one problem with automatic stabilizer is, of course, it will reduce the fluctuation, but it will not bring in complete stability. Okay, total stability is not there, so it will make little bit stable, right? And so that is why governments have to use discretionary fiscal policy, because it does not fully correct. If the fluctuation is very drastic, then discretionary fiscal policy will not be very. Do you think during that is this recessionary trend which we experience now can be corrected with tax and transfer? No, it's not possible, right? And so that is why the Keynesian fiscal policy. Every moment you have to think about Unit 2 that you have studied, the Keynesian school, what did it recommend? That is fiscal policy. Fiscal policy should be do in order to, in these aspects, deliberate manipulation to do this, to attain all the economic objectives, to attain stability. You remember, it's given in your book. Do you remember that is in Unit 1, you studied GDP is nothing but C plus I plus G plus X minus M. C plus I plus G. Aggregate demand you're talking about, isn't it? Aggregate demand. Consumption demand, investment demand, government demand for goods and services. Government is so huge. Then net export, effective demand. So fiscal policy is a demand side policy, not a supply side policy. What is the meaning of a demand side policy? What you are trying to manipulate, what you are trying to change is the demand, effective demand. Put more money into the hands of the people. C can be, depending on the marginal propensity to consume, C can, G can be manipulated easily because it's government's discretion. Then policies for export and import. Indirectly, you can make policy. And that is discretionary fiscal policy. It is for bringing in economic growth, for bringing in price stability. Please remember, it is a deliberate policy to reduce the effect of recession, to boost up GDP. Now, this is the right time of an expansionary fiscal policy. What is an the objective is to expand economic activity, stimulate the economy. When do you need stimulation of the economy? A stimulation is required when you feel that there is a contraction in the economy. How do you understand that there is a contraction in the economy? It is reflected in many indices. As you read the newspaper, you can find Purchasing Managers Index, Index of Industrial Production, General Prices, Inflation, right? So if these things are bad, like production, output, a number of people who lose employment, if these things are bad, you can always think that there is a possibility of contraction. That is what we experienced when COVID, lockdown was done. What did happen? Okay, we always felt that a recession is going to come. And so what was the government trying to do? Every day, 20,000 lakh crores. This number of crores, you read through your policies, COVID policies, you will find government was applying expansionary fiscal policy to stimulate the economy. Okay, to stimulate the economy and to keep unemployment I don't find any questions. Is it that questions have not come or? I will refresh and yes, I can see the question. Oh God, few questions. I'll answer these questions. Okay, now we go in full swing. We'll finish and then I'll answer. Right? 8:30 I'll answer the question because there are very few questions. And in case, yeah, very good questions are there. I'll answer very few, only 4 questions. Right. See, I lost my. When will the government use expansionary fiscal policy to stimulate the economy? When unemployment, it's written in your book, I suppose. If it is not there, please note it down. When unemployment is greater than natural rate of unemployment. When unemployment is greater than natural rate of unemployment. I hope you have understood in the second unit, there is a difference between natural rate of unemployment and cyclical unemployment. Natural rate of unemployment is, a frictional unemployment. Some people will keep changing jobs. Some people will lose job because they have come from another country. Some people, another country and are searching for jobs. Some people technologically unemployed. Some people don't want to work at all, right? So like that, there will be, that is not unemployment. That is voluntary unemployment. We are only talking about involuntary. We are willing to work, want to work, but can't find a job. Natural rate in any country is 4, 5, 6% of people will always remain. That is natural for any economy. But what is cyclical unemployment? Cyclical unemployment is more than the natural unemployment. Suppose a country has 10% unemployment, 5% may be definitely because of natural rate of unemployment, and the rest is due to trade cycle, cyclical changes in the economy. And aggregate production is less than, whenever there is cyclical unemployment, total production is less than full employment production. Go to unit 3. Why is production less than full employment production? Because that is the signal that the producers got. If you produce, you won't be able to sell. Then produce less. An underemployment equilibrium will come. It's known. That is a Keynesian contribution. Classical economists believed full employment equilibrium always prevails. But Keynes said it is not full employment. Whatever is produced may be sold. That is equilibrium. Isn't it? Whatever is aggregate demand is equal to aggregate supply. But still there will be some people walking unemployed. That is what Keynes was thinking. That was the problem during Great Depression, isn't it? There is equilibrium. Equilibrium is whatever is produced can be sold. Aggregate demand is equal to aggregate supply. But this happens at less than full employment. Some people, some resources are unemployed. This is a problem. I will not go much to Keynesian theory. So what to do? If you cannot sell, it is because people don't have employment. It is because people don't have money in their pocket. It is because aggregate demand is lagging behind. You have to increase aggregate expenditure. So what is the policy? The first thing I said, increase in all types of government spending. If private spending is not coming up, let government spend. Decrease tax so that more money is left in the pockets of people. So incidentally, 2 words come in your notebook, in your textbook. Pump priming, because when you talk about government expenditure, chartered accountant students should know what is pump priming and what is compensatory spending. It is not very relevant these days because you remember Nirmala Sitharaman said, okay, I am not going to do pump priming just like the previous government did in 2008. She said that. You know why pump priming became a very popular word? Because the previous US government, as US president, he was very fond of using the word pump priming. That is how now it has come to popularity. Pump priming is, come from priming the pump. That is, technically I won't be able to say. Priming the pump is, make the pump suck water or liquid, whatever it is, by exhausting the air in that. That is, you give an initial boost so that, water or fuel or whatever it is, that intake will be smooth. Just like that, an economy is to be given a booster dose, one single shot or 2 or 3 shot of expenditure by the government. Because private people are not spending money, let the government spend a huge amount, and it is like a plane taking off. Once the economy starts taking off, the economy will continue. It's sustained growth. That is pump priming. And what is compensatory spending? Compensatory spending is rather a continuous process of compensating the deficiency in private spending by spending by government. You will ask me, what is spending by government? See, government is providing infrastructure, it is spending. Okay, government is giving for pay revision, current expenditures increase. Government gives transfer payment. Yes, that is government spending. Government goes in for capital expenditure. That is also government spending. So somehow increase the government expenditure. And when government expenditure increases, what will happen? Come on, you remember in Keynesian theory, directly it will generate employment. Indirectly, it will create additional income through multiplier effect. You remember the diagram, aggregate demand and aggregate supply. If it's time constraint, please recall, or you can even open your book and see. Aggregate demand and aggregate supply, a small increment in investment creates a more than proportionate increment in income, so that we have the multiplier, multiple amount, isn't it? You have the multiplier, okay, multiplier. So just like increase in investment, you have done a problem, I suppose, into that is, what is multiplier? We have a formula also for multiplier, right? Multiplier formula that you have done is 1 divided by 1 minus MPC, or 1 divided by MPS, or 1 by 1 minus B. I hope you recollect it. That is the Keynesian fiscal multiplier. So once the government increases its expenditure, what is the effect? It is not that, suppose government puts in 2 billion rupees or $1 billion. The economy will experience increase in income not by 1 billion, but by a multiple of it. That is the principle of multiplier. And we know higher the marginal propensity to consume, higher is the value of the multiplier. Okay, if people spend the money which the government gives, say for example, government is giving, during COVID, the government is giving everybody some type of income support. And suppose I get my income and I hit the bank, there is nothing like a multiplier. Suppose I get the money, I spent it, my marginal propensity to consume is say 0.9, which is very high, then multiplier effect is very high, isn't it? So it depends upon government expenditure, how much of income it will generate depends upon the multiplier. Then taxation, expenditure here. How should taxation be? For example, taxation, rate of taxation. During recession, reduce the rate, increase the size. If you increase the taxes, what will happen? Disposable income reduces. There is less money in the pockets of people. There is less money in the hands of corporates. That's why corporate income taxes got reduced, isn't it? Of course, because US reduced and we should not expect a capital flight to US. All that is secret, right? But definitely, we have reduced corporate income taxes substantially so that there are more money for people. There are more money for reserves, more money for different purposes. So less money means less demand. Less demand means lower inflation. So during inflation, increase the tax. During deflation or during recession, decrease the tax. I told you, no? During recession, decrease the tax so that people have more money to spend. More money means more demand. Nobody sleeps with the money. I mean, nobody goes hungry or nobody goes without entertainment if they have money in their pocket. That is basic thing. If you have money, you're going to spend. More money, more demand. More demand, more aggregate demand means more production. More production means more employment. More employment means more job. That virtuous cycle, not vicious cycle, the opposite. Naturally, economy will pick up. Okay? Increase spend, increase the demand for goods, isn't it? Let us have it in our mind. Now, during recession, now we understand how during inflation and during recession. Now we have to talk about the tax multiplier. And that also we have done in Unit 1. The tax multiplier is the multiple by which an increase in tax or a decrease in tax would create, the change in income in response to a change in increase or decrease of tax. I will start with increase in taxes. Increase in taxes. What happens? Money in my pocket is less. Aggregate money in the hands of people for spending is less. What happens? Naturally, GDP decreases. Decreases by a multiple of propensity to consume. So that is why you have the tax multiplier always negative, given by the formula minus b divided by 1 minus b. That is there in chapter 1, please. Please read it. Just a reference is given in this chapter. Actually, the problem part should go to it comes from the division here. And the balance budget multiplier, we know it is equal to 1. So we have done 2 measures, that is public expenditure and tax for stabilization. The third one is budget. Budget as a method of stabilization. Budgets can be of 3 types. 3 types of budget, that is balanced budget, surplus, all that you know, I think. Balanced budget, surplus budget, deficit budget. Balanced is when income is equal to expenditure. Surplus, which is very rare these days, that is income is greater than expenditure. Okay, or expenditure is less than. Then usually what is taking place is a deficit budget where income is less than expenditure. Budget runs into deficit. You have to find, the government has to find money, go and approach people, countries, okay, to fill in the deficit or go for monetization, print a new currency, right? All that will have adverse effects. So that is budget, right? So whenever you don't have to talk about these 2, now we have to talk about income is less than expenditure, so that government borrows, and that is what is known as public debt. Public debt can be, as I said earlier, from inside the country or from outside the country. When you buy a national savings certificate, when you buy a treasury bill, when you buy a bond from the government, okay, when you buy a government security, you are actually lending your money to the government. Government is actually borrowing from us, right? You remember the open market operation, all that will come in monetary policy. Actually, the government is borrowing money. Government zero coupon bond, long-term capital bonds will be issued by the government. Short-term treasury bills. In India, we have treasury bills up to 364 days. Treasury bills are short-term bonds, isn't it? So like that, government is borrowing from the public. And when we buy these, say for example, if I buy a national savings certificate for 1.5 lakhs in order to get an exemption under Section 80 ATC, you know it better. I am poorer by, for the time being at least, my money in my pocket is less by 1.5 lakhs. What will happen? My demand this year is reduced by 1.5. Demand of different people who have bought government securities, lent money to the government. What happens? Aggregate demand will decline. So borrowing by government reduces aggregate demand. So when should government borrow? When people have more money in their hand during expansionary phase. During contractionary phase, what should the government do? Repay the debt so that more money. So the criterion, please remember, recession, put more money into the hands of the people. Inflation, take money away from the pockets of people. Not that theft should be done. A thief should come and take. Measures should be, discretionary measures should be framed in such a way that the purchasing power of people is reduced. Right? So budget can be used, balanced budget, budget surplus. In a budget surplus, what happens is leakages exceed injections. Right. So what happens is when a budget surplus, we are not putting money into the economy. In recession, we know we have to put money. So what that's about discretionary fiscal policy. Okay. Then recessionary gap, inflationary gap. These are two terms which we studied in Keynesian. There is a diagram and everything is given clearly there. A recessionary gap is what? A recession, no time to draw the diagram, you can turn the pages and see. In recessionary gap, you can turn the pages and see, chapter 1 please. In deflationary gap or recessionary gap, there is deficiency of aggregate demand. Deficiency of aggregate demand, that is, aggregate demand is not sufficient to maintain the full employment level. So when is this deflationary gap occurring? In the contractionary phase. When contraction takes place, income gets less. It is a contractionary phase of the business cycle. Then it is it's moving down. I mean falling portion. So what should you do? Unplanned inventories, all those theory you know. And so when it happens, you have to go in for what? In the contractionary phase, you have to go in for expansion. There are two diagrams in the book. For expansionary fiscal policy, I cannot tell you the exact page number because my version of the book is different. In the expansionary fiscal policy for combating recession. That diagram I have to explain because usually students ask why this curve is like this, why this curve. Now with the backdrop of your Keynesian theory, you remember what asset that you mark on the y-axis and what is it marked on the x-axis. Please look into your book. I'm going to draw a different diagram. Okay, I'm going to draw a diagram where the same diagram that's given in. This is long run aggregate supply. That is full employment level of full employment. Okay. So I will give it to the same name that's given in the book, Y2. Listen carefully. Y2. Y2 is the maximum. Please keep writing in your textbook. Y2 is the maximum. Y2 is the maximum that this economy can. Please note it is long run aggregate supply. Long run aggregate supply. If I mark price level here, okay, price level here, right? Aggregate demand curve AD1, aggregate demand AD1 is, this diagram is very easy to draw. Okay, aggregate demand curve 2, here we have SAS1, SAS2, shorter aggregate supply. Now you will ask me, why is that this aggregate demand curve is downward falling? And in first chapter, you said aggregate demand curve is a rising curve C plus I. Okay, so please note what is the difference between this and that diagram. On the y-axis, we mark aggregate demand. Here, we are marking the relationship between aggregate demand, aggregate demand and price level and real. Okay, price level and demand. Higher the prices, lower the usual demand curve, isn't it? Higher the prices, lower will be the aggregate demand. Lower the prices, higher should be the aggregate demand. So it's with the AD1 at this point. Short run aggregate supply. Why is higher the supply? That applies to aggregate supply. Higher the price, greater the incentive to produce. Lower the price, lesser the incentive. So initially, it is at the level of prices is P1. Please, many things are not mentioned in the book because there are maybe P1 and economy is at equilibrium, where aggregate short run aggregate, please keep writing, where short run aggregate supply is equal to short run aggregate demand. Okay, so what is full employment? Y2. Now the economy is at Y1. What is given in your book is Y1, right? Now, are you happy with this economy at Y1? No, because the economy is not producing full employment. Less than full employment means there is unemployment greater than natural rate, or there is cyclical unemployment, or the economy is in recession. It is producing less than full employment. Compare it to with the recessionary gap. It is producing at less than full employment. It is not producing at full employment level. So what the classical economists said is what is first given, this broken line. Okay. The classical economists said, right, when this happens, full employment will be ensured because people who are unemployed will be willing to work at lower wages. And people who cannot sell the products will be prepared to sell their product at lower prices. Got it? Prices will fall, wages will fall. When wages fall, come on, what is the attitude of the producers? Employ more labor because wages have fallen, ordinary economic theory, right? So like that, all the unemployed people will be willing to work at lower wages, and the producers will employ them. And so the aggregate supply curve will shift to the right, and it will come here, and full employment is a permanent feature. Okay, this is full employment. Aggregate supply will because when prices and cost reduce, supply curve, simple economic theory. When prices and cost reduce, supply curve will shift to the right. There will be increase in supply. With increase in supply, this equilibrium full employment will be attained. But this is not correct, is what Keynes said. It doesn't happen. It is wrong to say this will happen. It will not happen. So what will happen is government is not intervening at this stage to increase aggregate demand from AD1 to AD2. Government has to intervene with fiscal policy. Intervene so that AD1 shifts to AD2, right? And so what happens is when AD2 is shifted, we have full employment equilibrium ensured by increase in aggregate demand. How will you ensure the increase in aggregate demand? By government entering the economy through government expenditure or reduction in taxes. In other words, putting more money into the pockets of people. That is why, in order to increase their output in the short run, aggregate demand is increased. If aggregate demand is increased, what will happen? Production. Inventories will fall, isn't it? Desired inventories, and so inventories will be falling, which means production. Demand is there, production should be there. How will producers produce? By hiring more people, right? So unemployment problem is solved and full employment is attained. There is one more diagram that is contractionary fiscal policy. What is contractionary fiscal policy? Clear, no? When there is an inflationary gap. When there is an inflationary gap. That is, the economy is so heated up that everybody demand is so much. What happens is, even full employment level of output is not sufficient to meet the demand. It is not sufficient. So what will happen? Prices will rise. It is there in the deep inflationary gap. You remember, that is, more than full employment demand means real output. This is the maximum that it can get produced. You can't go beyond that. But if people are simply running after goods and services, what will happen? What will happen is, the same diagram can be used. It is actually the same diagram with only one difference. Please understand the difference. What will happen if people keep running for buying goods and services? If aggregate demand rises beyond the full employment level, you cannot expand output because every resource is fully employed. Then what will happen? Output will remain stagnant at this level. That is your next level, Y level. Output will remain stagnant, long run aggregate supply. The same diagram, AD1, AD2, then with only one difference, that is SAS1, SAS aggregate supply 2. So here, suppose the economy is having a nominal income greater than, say, Y1. Suppose it is Y1. What is wrong with Y1? See, the aggregate demand AD1 is actually going up. Aggregate demand, there can be many aggregate demand curves, like, okay, then aggregate demand is so high with a short run aggregate supply curve SAS1. What happens is, income is Y1. It is a little lack of less clarity there. Please note it there. Economy is already at full employment, real GDP. And we expect aggregate demand is going up and up. we expect it to go up to 82. What will happen? How do we control that? The economy is going up. We expect the aggregate demand to be going up to 82. So what should you do? You have to bring it back, reduce the aggregate demand so that you are back into equilibrium, full employment level, equilibrium, full employment. The prices will rise, substantial increase in price. If aggregate demand is supposed to go from, people demand is going up from 81 to 82. For each increase, you will find it will intersect with the full employment output like this, and you find as aggregate demand rises, price also rises. But quantity of output remains the same because this is full employment. Okay, you can't increase the quantity. So what will increase? Nominal GDP will increase. That is, price will rise because of inflation. Nominal GDP will rise. But this price rise is unsustainable. An economy cannot go for such boom or increase in price. And so what should the government do? Okay, go for contractionary fiscal policy so that the money is taken away from people and their aggregate demand. What is the policy? Reduce the government expenditure, increase the taxes, or do both together. Don't give any extra transfer payment. Okay. And the problem part, for example, it is exactly the same as unit 1. We need to wind up the class. Then the next portion is fiscal policy for long-run economic growth. It isn't very difficult. You can ensure that. You can read and understand. Fiscal policy for inequalities of income. That is, you can have a progressive tax. The rich is taxed more, then go for spending the tax money in such a way that it is beneficial to the poor. So that is a tax and transfer policy. Tax the rich progressive rate, collect the money, and ensure redistribution in such a way it's given. 7 or 8 items are given. How can you, to the backward communities, to the poor communities, free ration, subsidized education, free treatment, free health services, scholarships, strengthening human capital, anything you can write. Only very few points are given there. So for reducing inequalities, you can use fiscal policy. Then there are limitations of fiscal policy. I'll take 2-3 minutes. But suppose you put more taxes on rich people. What is that? If tax rate is very high, it is a disincentive to work. Right? A disincentive to work. I think we better wind up and continue in the next class because time is up. I need to complete 2 topics in this lesson, that is limitations of fiscal policy and crowding out, because they are important theory. Now, I'm going for the doubts. The first doubt is, which countries have adopted pollution taxes in order to lower the pollution level? Saurav, all developed countries. US, this is being practiced from 1980s. As I said, there are many economists behind the formation of this policy. Actually, the problem of sulfur rain in Europe, most of the country, almost every country is adopting this cap and trade. It's a very popular theory because their philosophy is capitalistic philosophy, that is, use market for solving market pain. That is why more than pollution tax, which is very difficult to administer, this cap and trade is really working. Okay, that's why I said, in India, we are practicing that. tax scheme, perform, achieve, and trade. We have carbon credits provided and given to us under the Kyoto Protocol, which we have signed. Right. So this is being practiced by all industrial nations and also some developing countries. Then Soundarya is asking me, ma'am, in case a firm has branch, then how does pollution permit work? If branch's pollution permit is clubbed with firm, and can firm be allowed to sell it? Is yes, because a firm is taken as a total entity. Definitely, it is a very complex mechanism of work, because it is, as you go to the 5th chapter, that's a very important chapter for your life. 4th chapter, you will find that, nations produce in different countries. It is multinational companies now. So a firm that is working in another nation or a branch, whatever it is, it has to conform to the environmental policies, environmental standards of the country in which it is functioning. Okay, so whether you have branches or whether you operate in different nations or whether you operate in the same nation, your emissions in advanced countries, I told there are computerized, detection systems which will automatically report the amount of emissions and the quality of the emissions and the quality of your emission abatement mechanisms. But we are a poor country. We don't have such computerized systems for instantaneously reporting systems. But definitely, we are also. How many of us thought that fast tags will come? Fast tags were prevalent in Europe and other countries so many years back, isn't it? So things will automatically and slowly come, because technology is something that we cannot evade, right? How underproduction will have positive effects? No, please, Meghna Mishra. Underproduction occurs whenever there is positive externality. There are two outcomes you have got to think. A positive externality, what is the market outcome? The marginal social benefit curve will be, the marginal social benefit curve is the right of the marginal private benefit curve. So what is actually required, what is actually socially optimal is much more than what the market actually produces. You remember, in negative externalities, we said there is overproduction and lower prices. Right? In positive externalities, merit good, education, health, left to the market, they will think only about private cost and private benefit. Right? But social benefit is higher than private. So what is socially desirable will not be produced by the market. So your question is underproduction. No, it is the other way around. When there is positive external, go home and read, then you will understand, or I will send you a mail if you want. For example, when positive externalities are present, the argument is we cannot leave things to the market, because the market will only produce insufficient quantities of goods like education and health, which has got substantial positive externalities. That's why government is entering, and that's why government is giving subsidies, so that production will not be left to the market, or some incentives will be there by which market produces socially optimal quantity. I hope it is clear. Then habitual goods always are. Yes, definitely. Kiran Kumar, goods which are habitual. Aren't you using a mobile phone? If your mobile phone for not your mobile phone, somebody's mobile phone by accident falls and breaks. Will you walk without mobile phone? Somehow or the other, we will see that the mobile phone is gone. If people are in the habit of reading newspaper, if people are in the habit of drinking coffee, if people are in the habit of using alcohol, right? If people are in the habit of reading newspaper is also a habit, isn't it? Definitely, even if the price rises, we will consume more or less the same quantity. So habit forming commodities have more or less, not perfectly inelastic demand. Instruments of fiscal policy, Nagul, yes. With this, the problems are getting more. That is instruments of fiscal policy. The entire lesson is instrument of fiscal policy. The income of government in the form of all types of taxes. The expenditure of the government for all types of expenditure. The budget balanced surplus or deficit. So deficit budgeting is a very important topic we teach in public finance. So that is also an instrument of fiscal policy, right? So that is the income of the government, the expenditure part of the government. How you balance the deviation or the divergence or the difference between income and expenditure is also deficit finance. How you finance deficit? For example, I said the government borrows in the market. When should the government borrow? For example, during COVID time, can you expect the government, suppose the government borrows money, what will happen? Already we don't have money in our pocket. And the government is taking away money from our pocket. What will happen? Our purchasing power will improve. So during recession, do not borrow. During recession, put more money. I said 3 catch points, 2 catch points. That is, during recession, put more money in. All policies should be towards giving more purchasing power to the people by giving more money into the hands. During inflation, take away the purchasing power. How do you take away the purchasing power? Reduce the quantity of money available. That's why when you learn monetary policy, in how interest rates and money supply are adjusted for recession and inflation, that you will study. Anyway, thank you so much for your patient listening. We could not finish the second unit, the entire second unit, but I think we have substantially done. And I hope you will go home and read the questions and also connect this part to the numerical part given in Keshi theory. And it is already mentioned in the textbook that the numerical part should be taken from the Keynesian theory, that is unit 2. Thank you so much and wish you good learning. Thank you so much. Thank you. Yeah, session is over. Thank you, Ranjit. Thank you. Thank you so much.